Welcome to the Practice Round 1 Aftermath. What we're going to do in the next 3 videos I think is incredibly important. I'm going to talk about how I go through the decision-making process and how I evaluate the information that I get from these reports. Analyzing these reports and making decisions from them is critical to your success in BSG, and to me, more importantly, is critical to achieving the overall goals we have in the simulation, which is to help you with your critical thinking and your decision-making skills in a business context. So I told you that I typically take the role of the middle team. So the middle team in my scoreboard is Team F. And so throughout the rest of the videos, I will assess them as though I'm Team F, and I will act like I take the practice round seriously, which again, we all know we don't really take the practice round seriously. So this is nothing to do with Team F. This is just all about learning. So I look at this to see what the span was like. Team A fell out the bottom. Again, it's the practice round. No offense, Team A. But D, G, E are the ones I'm principally going to be looking for because they're the people that finished above me. Now, this is the most current round. In the future rounds, this is game to date where it's cumulative. So I look this because this tells me how things went in the last round, but I also keep an eye on this. That'll become more relevant. Typically, I don't see a lot of interesting information on these charts because they tend to follow that lead chart. But in fact, on this one, we do kind of, and that is, this Team F, I have the second highest earnings per share, the second highest return on equity, and a stock price that it's not quite as high. That's very puzzling because stock price is based on largely financial results, but I'll show you later in the data why I'm getting dinged. So typically I look at these, but I already have a pretty good feeling for what they're going to be looking at the first screen. In the practice round, I did not remove the credit rating from the scoring. In the real rounds, I do, not because credit rating isn't important, because it controls your cost of borrowing, but for the very reason that we see here. I took on some debt, extra debt, and some other factors, and it caused my credit rating to be only a B. Now, I'm not saying that's not important. I'm saying that in the scoring of the game, that has a bigger effect than I think it should. And so that is part of the reason I did so well with my earnings per share and return on equity, and so middle of the road in my other scoring. Also, I look here and I see that my image rating is very low, 62. That is not good. Typically what that signals is that I've lost market share. I'll see that when I get later on into the competitive intelligence report, but that's very concerning. In fact, I have the lowest image rating in the industry. Not only is that bad for this round, but that starts me off in a hole in the next round because my image rating in the prior round affects the demand for my shoes. So that's bad. Corporate social responsibility, we see a very wide range of investments, a low of 0. That's not the right number. A high of 12 million, that's probably too high. An average of 7.5 million, that's probably a little on the high side for the average as well. Over time, you're going to see who wins the CSR awards. I don't particularly care if you win CSR awards. What I would really like to see is that you get a lot of image points and that you do it as cheaply as possible. In other words, you make the right social responsibility investments to boost your image without spending a ton of money. Bonus points, I look on here because it's the first time I get a look at my revenue, and I'm like, well, this is interesting. My revenue was up by 11% over what I forecast. That could be because that I won more special order bids than I thought, and so my revenues were up, so my earnings per share were way up. No bonus point for me. Typically, the teams that do the best are the ones that win the bonus points because they had accurate forecasting. But sometimes teams can have very accurate forecasting and do like me and just not shoot very high. So even though my revenue was 11% higher than I was expecting, it's still the lowest in the industry. That's typically not a great place to be. And that makes me again think I probably lost a lot of market share. And my guess is that I overpriced my shoes vis-a-vis the industry. And I made good revenue on what I sold, but I didn't sell a lot because people were walking out of the store going, "What? They're overpriced," and not buying my shoe. Leapfrog Award, pretty self-explanatory. There won't be one in the first year. You only obviously want to win at most one of these. If you're winning more than one, you're not doing all that great. Now I start to get into an idea of the industry as a whole. This talks about the ratio of standard versus superior material usage, something I'm going to want to take a look at. This talks about utilization of production capacity. You can see that we pretty much used our facilities pretty heavily. And so that's going to signal that in a year or two, it's going to be time to start upgrading facilities to add capacity so we can produce more shoes. Some details here. You can see in the various regions, like in the Asia Pacific region, as many as 4 companies ran out of shoes. Okay, we'll look at that in more detail a little bit later. Over here, this is interesting. Private label pairs offered was lower than actual private label demand by 45%. So not that many people played in the private label market. And then some comments about demand and supply. And then this is an important area where I get to see what other people are doing. Again, this being the practice round, no surprise. Nobody didn't initiate any construction. But in the future, something you're definitely going to want to keep your eye on. So this is my total revenue. And again, this shows that I was well below the industry average. And it's very concerning to me as I go into the analysis. I do see that I had great success or good success in the private label market. My internet was very low and my branded was low. So particularly my internet sales were down, but my branded wasn't anything to be thrilled about. I get over to here and you can see everybody made good money. Not surprisingly, D made the most money, which is what you would expect. This is where you can see if somebody's taken out a lot of interest or taken out a lot of loans, because their interest will start to be different than everybody else's. And then you come over to net profit, and what you see again is very unusual. I am in second place in terms of net profit, but yet I finished much lower in the overall rankings. And again, that's because of the credit rating, but also because of another mistake. I'll show you that obviously the stock price is factoring in. As I come down here, I see that some interesting information. This tells me that I took out quite a few loans. So you can see my current loans are $23 million above the industry average, and I'm about $6 million above the industry average on long-term loans. So relatively speaking, I've taken on some debt. I also bought back some stock, which it's not a bad strategy to buy back the stock. What's interesting is that in the profit, I finished in second place, but in overall, I finished in fourth place. That's unusual. Usually the place finishes will track very neatly with the profit. But when you make some of the mistakes I made, you do see some deviations. We get down to the profitability measures. Sometimes these can be a little different. For example, you may think it's always great to have the highest net profit margin, but if you're running a volume-driven cost leadership strategy, you might actually have one of the lowest profit margins, but be killing everybody else because you are upping the volume so much. This also is interesting to me. I wouldn't have expected this. I'm the only one who raised my dividend very slightly, but you can see I took a real hit on my stock price. Part of that was because of my credit rating being reduced to a B, and here you see why. But this is a real problem for me. I have 167 days of shoes in inventory left over, and from that I instantly know that I produced a bunch of shoes that didn't get sold. And the bad news for me is that's a problem that's going to continue into next year, because now I have all these shoes in inventory that I'm going to have to do something with. When you call up your particular products, it will have your company here and it will have your numbers here. This is a very important chart, and this is where you really start to get into the, we talked about how we did, we've looked at some issues of why we did, although we're going to get into a lot more of those, but this is a big issue of why we did, so to speak. And I'll give you an example. in the North American plant, you can see there's about an 80-cent difference between the highest labor cost and the lowest labor cost. 80 cents turns out to be 4 or 5% of your profit margin. And so that's a pretty big deal. If I look down here in Asia Pacific, it's even worse. There's a $1.15 difference. So this company, whoever this is, had a real advantage in this round. Now, is it sustainable? It depends. If they cut their wages, slashed their wages, and held back on investments, well, they got one round of a low wage but still reasonably productive workforce, and it'll get a lot worse faster for them. So I don't know that this number is sustainable, but you can see this can help explain why you did as you did. All of these things are important to keep your finger on. But again, you're not always going to be trying to do all things to all people. It may be because of your strategy, you're going to run a little bit higher reject rate than a lot of other folks. What you don't want to tend to do is be this guy here with the highest reject rate in the industry. Because even if I'm doing a strategy, for example, running a lot of models that would tend to increase my reject rate, I want to manage that so I'm certainly not the industry high. Or if I am the industry high, I'm still pretty close to the average because there's not that big of a difference. Same thing here. Your company printouts will be right here. Your company number will print out here. And these are very important things for you to look through and start to build a picture of why you did as you did. And you can see there's large differences in profitability. In North America, in the wholesale segment, there's a $9 difference between the low and the high in terms of marketing expenses. And there is what, an $18 difference between the low and the high in terms of operating profit. Those are very substantial differences. It's good to know where I fall, and that is important information about why I did, and then start to tip me towards the how I can do better. This is the private label market. Again, my numbers will be here. In the celebrities, you all paid very little money for your celebrities, and lots of celebrities are upset because they didn't get signed. But you know what? If you're able to land celebrities at this price during the actual competition, that'll be wonderful. I guarantee you're not overpaying for a celebrity if you're paying less than $1 million for the celebrity. And you can see here how it worked. You can see that Team C outbid Team D, and that's why they got the celebrity they did. Down here, these are kind of handy charts to go over to say what's the trend in pricing and quality. That takes me through the footwear industry report, and the main thing I get out of the footwear industry report is I get a very good handle on how I did, and I start to get some great insights on why I did. As we get into the competitive intelligence report, then I'll get more on the why I did.